Good morning, everybody. Thank you for being here. Welcome to Fundamentals with Matt Burk. I am your host, Matt Burk, and the show is all about real estate entrepreneurs who set up, run pooled investment funds, some of the hows and whys and when to do it and when not to do it, and some of the challenges and issues and opportunities that go along with running real estate asset-based pooled investment funds. So appreciate you being here today. I have a guest that I've known for probably a better part of 10 plus years, I think. Dean, I think we maybe first met at the Apple AAPL, American Association of Private Lenders event down in Vegas, I want to say.
Good memory.
Back in the day, maybe that was 2013 or 14, somewhere in there.
Yeah.
But anyway, welcome to the show.
Thank you. Good to be here. Good to see you again.
Yeah, you too. It's been a while. So Dean, I met, like I said, I met Dean as a private lender down in Vegas at the AAPL thing. And then we got to know each other. And this was kind of back at the time when we were first starting to do the work, helping people set up funds. And we ended up, Dean hired us. We helped set up that first fund years ago and stayed in touch a little bit over the years, but haven't really spoken all that much here the last few years. So I'm excited, Dean, to catch up with you a little bit today and see what you got going on these days.
Great. It's been a great journey since that fund launch that you helped us with back in 2014.
Yeah. So why don't we start there a little bit? I know your background prior to launching the fund, maybe give people a little, because I get this question a lot too, is like, am I ready for a fund? And, I've done these things in real estate before, but why don't you give us a little background before you started the fund? What were you doing leading up to that time?
Immediately prior, I'd been hard money lending for about 9 years prior to launching the fund.
Mm-hmm.
Prior to then, I was in the value add multifamily business. Prior to that time, I'd worked for a big property owner back in the late 80s and during the 1990s. But in leading up to launching the fund, though, I had been financing the loans that we were making really started back in 2005 from both a line of credit, and then as the market began to need a lot more private capital post Great Recession, with a lot of private investor capital. And it was a very inefficient way of raising capital on a transaction by transaction basis, given the number of transactions that we were doing during that time frame.
Yeah.
And we got really good at managing all those one-off transactions with investors and matching them into loans. But it really wasn't the best method. And so we were looking for a more efficient means. And that led me to meeting you and hearing about how you were working on some mortgage pool.
Yes. Were you doing them? Were you doing like matching one deal, one investor at a time, or you were syndicating the loans like individually and putting multiple investors into each individual deal, or what were you doing?
Both, really. We did a lot of single family loans, a lot of loans that were being repurposed into rental properties and sold to these hedge funds that had been created. Yeah. And in those, it was almost always one investor, one loan, and they'd allow us to hold the money and roll it into another one right after one would pay off. But on the larger loans that we would do, there was usually a handful of investors that might go into those that would syndicate.
Yeah, in a lot of ways, Dean, and I think this is why we hit it off early on. But that was very similar to our story, right? We did loans and did them one at a time and matched them up one deal, and that's tough because you got to find the deal, you got to do it in a timely manner with the borrower, you got to find the investor, have the right dollar amount, negotiate on both sides, be in the middle of the trade, and then try to put it all together. And if you do that one at a time, if you did one deal a month, not a big deal. But if you're doing 2, 3, 5, 8, 10, 12 deals a month, man, that's just a ton of work. So that's kind of what gave rise to your thinking about the fund, and then maybe walk people through a little bit as if you think back. I know this has been a while now, but thinking back on that time, what was going through your mind about setting up the fund and some of the concerns that you might have and things you thought they might do that you've since learned, that either got corroborated or different. Give us a little insight on that.
Sure. Well, first concern was how would the investors that I already had like the fund model. And so when we really thought through that, there were some benefits to the investors. In the prior model, they were tied to a specific asset. And in the new model, they really had a lot more diversification. So they had a more diversified investment, and they also had longevity. So they would be able to come into the fund and remain invested, really potentially into perpetuity, um, with off ramps through redemption opportunities. But kind of became the best of both worlds for them. And certainly for us, it gave us more certainty of capital having it into the fund model. So it took a lot of time to really work out all the terms that that go into creating the fund. And I think that was really important that um, those structural things be very well thought out to match both the business that you're trying to capitalize, as well as the investor base that you're going to be marketing to. Um, so yeah, a lot of thought had to go into setting it up right so that that you're able to execute that we were able to execute on the plan.
What percentage of your investors would you say came over to the fund from being a one-off, one at a time? Because my experience, a lot of those people, they like doing that because they get to pick and choose each deal, right? They see and touch and feel and taste it. So was it 50%? Was it most of them, or a fraction?
I think it was probably 50% originally. Thankfully, it was some of the more active ones that came over, and some of those that didn't initially came over later.
Yeah.
One of the things that we did was we went to some key investors when we launched the fund, and really pre-sold them on the fund structure. A couple of those we put onto an advisory board that we established at the time that we launched the fund, and it really helped with the initial launch of the fund. We've got these key investors that have already committed to it, and they're part of an advisory board. So that was really helpful in the initial marketing of the fund.
And then did you continue to do deals at all one at a time, or did you just go completely to the fund model at that point and discard completely one at a time deals?
Mostly we went to the fund model. There was a period of time where we kept a pool of capital outside the fund, and it was really just for when deal volume became too great for the fund to handle. As the fund was growing its capital base, simultaneously we were out marketing our business, and we didn't want to not be able to close business that came in. So there were times where that overflow really just went off a line of credit that we had. But we also over time have, with some of the larger loans, we make some small balance commercial loans, and some of those loans occasionally are larger than what we want to keep in the fund. And so at times we'll do a loan participation with an outside investor on those transactions that really invest alongside the fund.
How do you deal with like the cherry picking issue? I know I get that question from investors a lot. Like, how do I know you're not, taking the really good deals and putting them outside the fund and then putting all the crappy deals in the fund? How do you guys deal with that?
Really, just when I've had that question, well, first of all, today they really don't do any outside the fund. The only time we have an outside investor is where the fund is invested alongside.
Yeah.
But previously, when I had that question, it was really just explaining the intention to keep the deal flow coming in, keep the reputation of being able to close what we commit to close, and really not trying to cherry pick anything.
Yeah. Yeah, and I think a lot of times we'll build into the documents themselves that the fund has sort of the right for a first look at any of the deals that come in through the sponsor's business. So you have, and then of course that becomes incumbent upon the manager then to honor that right. But our experience is that it wasn't, to your point, it was never a cherry picking issue. It was just a capital issue. If the fund didn't have enough money, then
right.
We wanted to do that deal. We had an investor that would take that deal. If the fund doesn't have the capital, then you do it outside the fund.
That's right.
What were some of the biggest challenges? Let's say, I know you've been running the fund for 10 years now. It's like, in the life of any fund manager, things come up that you don't expect, right? What have been some of the biggest, maybe things you didn't anticipate, or challenges that you have had along the way that you've had to deal with inside of a fund?
I think, certainly we've seen a lot of mistakes on the borrower side. Those mistakes are usually rooted in underestimating the amount of time or the amount of capital needed.
Yeah.
But as far as our side, I think, well, initially, I think we intended to, in the initial creation of the fund, we were going to create another class of investors that were lenders to the fund. And we found that was difficult for us to raise capital for. And instead,
Mhm.
we modified our fund to work off of a credit facility with a bank, and that's been
Yeah.
very effective for us. Um, and so that was one of the things that we learned, and we really pivoted pretty quickly on that. I think really track record is the most important thing, and we stubbed our toe in 2016, I believe it was, on a few loans that turned out to not be good loans. That affected our return in 2017, really the only year we were below our target return. Um, and we learned a lot of things from that. We changed a lot of things within the company, and I'm really, really proud of where we've ended up since that time. But it's just really important to basically, every time you make a mistake, sorry, I have an
You got your
motion
auto.
activated light in here. But every time we make a mistake on a loan, we'll do a postmortem and try to learn what we can and change what we need to change within our system here.
Yeah, well, and look, if anybody does enough deals over time, right? Nobody's perfect. It's hard to underwrite every single deal and have all of them perform according to plan. But definitely the best managers learn from their mistakes, right, and figure out how to improve systems and try to avoid the mistakes. But you're fine. So you're still running the same fund that you set up back then, right? And how big is the fund these days?
The fund's AUM is about 85 million, I believe.
Hmm.
Um, and that's comprised of about 50 million of debt under our line of credit and 35 million of equity.
Yeah.
Um, our lines currently got capacity up to about 70 million, um, dependent upon, of course, additional equity
Yeah.
from investment capital.
Yeah, so that fund's aged pretty well. That's good. That's good. It's interesting to watch, how people have done with funds and see how they all take on a life of their own, certainly as time goes on, and to see that it's still going after close to a decade, that's great.
Honestly, on that topic, we looked at doing a separate fund that would strictly be focused on commercial assets and separating that business out of our current fund.
Hmm.
And a lot of the conversations that we had with potential investors in that fund were, hey, this looks interesting, but Bay Mountain Fund One has a 9-year track record. I'd really like to get into Bay Mountain Fund One. So we pretty quickly decided,
Yeah.
well, let's just not move to that fund. Let's work on growing Fund One and continuing to focus on what's worked.
Yeah, and we've done plenty of funds over the years, and there's every fund is a lot of work, right? There's a lot of extra. You got admin, you got tax returns, you got to prepare, you got different reports you got to put out to investors. It's like having multiple funds is a lot of extra work. So I do encourage people to try to, and I've learned this, Dean. I mean, we made a bunch of mistakes early on with trying to get overly complicated. It's for the benefit of the investor, right? But complication equals confusion. Confusion equals challenges and problems, and so the simpler the better. I've learned over the
Very
years.
true.
So what else are you doing besides the lending fund? I understand you're involved in another line of business, right, in the multifamily side. Tell us a little bit about that.
Sure. So that company is Calterra Capital Partners. And Calterra is a ground up developer of multifamily in Texas, primarily in the North Texas area around Dallas Fort Worth, as well as Central Texas between San Antonio and Austin. And we are about 7 years into that business. We've currently got 1,100 units under construction. We've sold everything that we previously completed. And and as I said, we're a ground up developer of multifamily as well as mixed use, but our primary focus is the multifamily component. And I have a few partners in that business that are very strong, and one of my partners, Clint Nolan, really runs that business, and we're bullish on Texas and the Texas economy, and we we still see opportunities. We believe there's going to be even though there's tremendous supply coming online, there's going to be a dearth of supply delivered in the 2025 to 2027 timeframe.
Yeah.
So we're being selective, and we're being creative in putting capital structures together.
Yeah, I was going to ask about the capital structure because that's really where the focus on this show, right? Is like, how do you capitalize that business? Do you do that in a fund format? Are you syndicating them? Are you putting own capital in, or how do you guys do it?
A little bit of everything, and not a fund structure. We are, it's generally bank financing, which a year or 2 years ago was at 65% of the stack. Now it's 50, 55 maybe.
Yeah.
And so we're having to get a little more creative with structuring capital in there. There could be a preferred equity piece that might take us up to 80%. And often there's a pretty big gap there, even after that, given the size of some of these projects. So we're working with some pretty strong partners that we have done business with in the past to help us fill that gap. And then we're, of course, co-investing in these transactions, both with our own capital and with our network of capital that comes into. They pretty much come into the land closings and then become partners with our equity.
Roll into the deal, and then so you're syndicating the deal amongst a number of multiple investors on a deal by deal basis.
That's right.
Yeah, which is generally, I mean, that's a great way to go for a lot of people. And, some people try to get past that and do it in a fund format. And some, depending on deal volume, right, that works perfectly fine, especially on development deals.
Yeah, for sure. And I think it'd be hard today to put a fund together for blind pool development, given the state of the market. But certainly in a different market, I think that's potentially an opportunity.
Yeah. So what else are you? What do you like to do for fun? What are you working on these days that gets you up and gets you excited in the morning?
Well, my wife and I are building a lake house, so
nice.
We've always liked going out to the lake, and so that's what we're sort of doing for fun, and hopefully a lot more fun when it's complete. But I just really focusing on business right now in terms of the lending business as well as the development business. The capital side of things is a place that I think needs a lot of attention and is where the opportunity is to differentiate from all of our competitors.
How is the market these days for private loans? I mean, we've got a whole bunch of deals that we're out in the market looking at financing, and the capital markets, of course, are in a great deal of flux and dysfunction at the moment. But how are you finding it on your business in terms of opportunities to make loans to people and how to underwrite them given changes in values and all of that?
It's interesting. So, we do a variety of loans, everything from single family to almost all types of commercial loans, including land to a point. So business really ground to a halt in the fourth quarter of last year. So there was not a lot of transactions, very slow. Picked up some in the early part of this year. And I think on the single family side, it's actually the pipeline's been surprisingly active. And on the commercial side of things, I think we've been expecting this avalanche of deals as a result of all the volatility in the capital markets right now. That hasn't really come. it's picked up in the last couple of months, but it was very slow to come. I fully expect it to be very active over the next couple of years, but it's a little surprising that it hasn't really come. Fundamentals are still really good on most of these commercial assets, unless you're an office deal.
Yeah, exactly. Yeah.
But yeah, it's just now starting to really pick up in terms of seeing quality opportunities.
Yeah. That's that's an advantage also of having a fund, right? Is you got the ongoing management fees or loan servicing fees that help keep things afloat when all of a sudden the deal volume and the points and the transaction income is just not there, right?
Yeah, that's true. And of course, business plans are taking longer too. So durations are going up.
Yeah.
So you've got to manage that side as well.
Yeah. Yeah. Well, we're kind of running out of time, Dean. It's been a pleasure catching up with you again. Before we went live here, we were talking about podcasts, and I always ask everybody, what's kind of one thing that's keeping your interest these days, or what podcasts do you find valuable that you can share with the listeners?
Well, I love podcasts on entrepreneurship, so I listen to a lot of those. And I would say that the one I listen to the most of is The Fort by Chris Powers. Because it started as mostly real estate entrepreneurs, but now it's entrepreneurs of all type. And I find that to be super interesting, super relevant to everything that I do. So
it's called The Fort?
The Fort by Chris Powers.
Yeah, I'll have to check that one out.
And I'm looking forward to listening to more of yours, Matt.
Yeah. Well, if you want to know a little bit about funds, then this is the place to come. So, Dean, appreciate you being here, man. Thank you very much for making the time. It's good to catch up with you. We'll catch up offline here soon. So, thanks a lot.
All right, thank you, Matt. Appreciate it.
Okay, thanks everybody for being here today. We appreciate it. Episode 16 with Dean Lontos. Come back next week, episode number 17. We'll look forward to seeing you then. And in the meantime, stay sharp.